given the data that we've seen in Europe, is the ECB likely to backtrack at all on its withdrawal of stimulus?
Well, I think it's difficult for the ECB because the ECB's withdrawal of stimulus has never really been so much about the strength of the economy. Obviously, we have seen some very good expansion in 2017. It slowed across 2018. But the inflation outlook for the ECB has always remained relatively low. So, firstly, we think that they closed QE not just because they thought they were meeting their inflation target, or would do, but because they were running out of things to buy. And I think that constrained their policy there. When we look at their interest rate policy, we think they now wonder whether negative rates is a good idea for the Eurozone, whether it actually does more harm than good to some financial institutions at this stage. So even though we're seeing an economy that looks like it's settling back to trend, an inflation outlook that looks like it's going to remain subdued, we still think the ECB is likely to lean towards removing negative rates. Now, it will probably try and characterise that as not a tightening in policy, but a normalisation. Nevertheless, we think they are likely to move ahead, but there could be some delay to that. They're signalling towards the end of September. If the data continue to be weak, then we might see that push back. But as I say, we are expecting to see better sequential growth as we move into the first half of the year, and that might keep the ECB on track for now.
OK. There's a clear line to be drawn as well between the Eurozone economy, particularly Germany and China. We were just recapping the earnings and talking about how it was a mixed bag of various corporates, either positive or negative, on what they were seeing in China. You know, we get these weaker PMIs today. You get Barclays saying that we're going to get that benchmark interest rate cut as soon as today. Is stimulus going to save any kind of slowdown that we get from China in 2019?
It's certainly part of our story.
Right.
Yeah. I think you need to see that pickup come through from China. It looks like the slowdown that we saw across Europe, I mean, there were some idiosyncrasies for Europe, but particularly for Germany, that slowdown looks like it was driven by a key deceleration in the Chinese economy. We know we're seeing a lot of stimulus across the board in China, not just monetary, but also some fiscal stimulus. It will take some time for that to find traction in the economy. Infrastructure spend looks like it's picking up already, but in the broader Chinese economy, it's going to take a little bit of time, probably into the second quarter, and it might take some time, therefore, to spill over into the rest of Europe. But yes, we think that you do need to see stabilisation and some pickup, which we think the stimulus that the authorities in China are providing will lead to before you see a stabilisation in Europe as well.
What more stimulus do you think we're going to see in the short term? I mean, could this benchmark rate cut come soon, particularly when you look at the rate differentials and what's been happening in global monetary policy?
Certainly there's more scope. I mean, the Chinese authorities were careful with this because of what was happening with the renminbi, and they certainly didn't want to put too much downward pressure on that. We think there's more scope for that to come through now, but we're looking more at RRR cuts. We would expect another 2 or 3 of those across the course of the year. But I think they want to focus more on fiscal policy than monetary policy at this stage.
Got it.
And we're seeing a lot come through there too.